Hey there, it's Walter here, and I want to talk about this guy right here, Victor Niederhofer. I don't know if you know his story. This is a story, Education of a Speculator. I don't know if you know his story, but he's an interesting guy because if you've heard of The Black Swan by Nassim Taleb, then you may not know that actually Nassim Taleb's mentor was this guy. And Nassim Taleb actually learned a lot from Victor Niederhofer, who, by the way, I think he was a champion squash player. It's a little known fact, unless you know about him. But what's interesting about Niederhofer is he actually his training system was basically the classic picking up the nickels in front of the steamroller. So he would get this money every day, and reportedly he's gone broke twice doing this, by the way. So you should note that. And by the way, if what we're going to talk about here makes sense to you, you might be interested in the Small Accounts, Big Profits course. You can click the link below or above this video and get more information on that. So what Niederhofer did was he would make a little bit of money every day, and then boom, he'd go broke. And when he went broke, he lost his fund, he lost his house, his wife, his cars, everything, right? Gone. So then he started another fund, did the exact same thing. He was picking up nickels in front of the steamroller, and then boom, bam, lost it all. Reportedly. I don't know him. I don't know all the facts behind it, but that's reportedly what happened. So the question is, and I'm going to link this back to Nassim Taleb from The Black Swan in a moment. The question is, why did he do this? Why is there's this real desire in people to be right and to make money every day, even if it's just a little tiny bit, at the risk of losing everything? Because that's clearly what he did. Reportedly, that's what he did. He tried to make a little bit of money all the time, and it was basically the assumption was that the market wouldn't move very much that day. If it didn't move very much, he was fine. He was golden. But as soon as the market started moving and drastically going further than he expected, that's when things would fall apart for him. So and so why does he want to do that? Well, I would submit to you that we all want to do that. We all have this desire to be right. We all have this desire to make money every single day. That's why scalping is so attractive to so many traders. But I don't think it's necessarily right for everyone. And here's why I say that. The fact is that when you try and make money every single day, a lot can go wrong. And unless you're right there on top of your game, a lot will go wrong, and you're going to lose. And you're going to lose a lot. And the same goes for scalping, taking 10 pip trades, or doing what Niederhofer did. It doesn't really matter. The important thing is there's this dichotomy in trading. You can either decide to lose often and win big, or decide to win often and win small, right? And so if you're going to win often and win small, like Victor Niederhofer, you have to make sure that when things go bad, when the market does some crazy stuff, that it's not going to hurt you too much. And he didn't do that, apparently, so that's why he went broke twice. So when you're thinking about taking a quick profit or using a system with a very low reward risk ratio, just keep in mind that there are a couple of things that can go wrong. Number one, your broker can slip you, and your broker will slip you when you start to make money. I've tested this. I've taken fresh accounts and applied the exact same strategies at the exact same time as an advanced account that is known to make money, and the known account gets slipped and the fresh new account doesn't. So I don't care what anybody says, and I'm talking about reputable brokers too. I'm not talking about dodgy brokers. So I don't care what anyone says. As soon as the broker knows that you're making money, you go into a different. All your trades are hedged, and you go into a different category, basically. And if you really want to get tricky, you can Google the things that brokers can do with their platforms, like MetaTrader or what have you. You can see all the crazy stuff. So here's the thing. If I have a small trade where I'm looking to make 10 pips, I can get slipped by 1.5 pips, and I can lose literally 10, 15% of my profit by my broker slipping me. That's huge. If I'm trading like the 8-hour chart or the 4-hour chart or the daily chart, and I have a 250 pip stop loss, and my broker slips me at 2 pips, who cares? It's nothing. Or 200 pip stop loss and a 500 pip target, for example. That doesn't matter. It really doesn't matter. Like that. Yeah, it's not. It'll add up over time, but it's not nearly as big a deal as it is when I'm trading the lower time frame and looking for 5 to 10, 20 pips. That's when it hurts you. So keep that in mind, that our bias is to want to win. And if you ask somebody who doesn't know about trading, they think that, yeah, you got to win. If you want to make money, you got to win more times than you lose, and so forth. But that's not necessarily true, unfortunately. Unfortunately, it's not. You have to learn to lose. And if you can learn to lose, then you can do well. So now what I want to talk about here is how his student, Nassim Taleb of Anti-Fragile and the Black Swan fame, Nassim Taleb now, he consults for hedge funds, and they'll ask him, how should we manage our risk? And he shares how they should manage their risk, right? That's what Nassim Taleb does. Well, here's how he trades. He trades exactly the opposite to Victor Niederhoffer. And by the way, long-term capital management basically did the same thing that Niederhoffer did, just a little bit more sophisticated, and they were very highly leveraged, which was unusual for a fund of that size. But anyway, it's essentially the same mistake. Now, here's what's interesting about Nassim Taleb. He says, okay, what I want to do is every day I'm going to lose a little bit of money, lose a little bit of money, lose a little bit of money. So his equity goes down, 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 right? Over time, it's down, 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 down. And then one day he wakes up and hits the mother lode. And that's exactly the opposite to what Niederhoffer did. Because one day Niederhoffer wakes up, he loses everything, his house, his wife, his cars, and everything, reportedly, and he did it twice. Whereas Nassim Taleb, no, he's like, finally, he hits the jackpot. And it's called Bleed. It's a system called Bleed, where he basically buys really cheap options, and once in a while the options become worth a lot of money, essentially. And the reality is, if you look at the data in the markets, and I've done this, I've actually looked at the markets, and I've run a study, and I say, do the distribution of daily movements fit the normal curve? And the answer is no, they do not. Now, this has really strong implications for trading, because if we don't have a normal curve of distributions in the markets, what does that mean? Well, it means that we're actually seeing more volatility than we should. In other words, we have fat tails at the end of the distribution. So how do you take advantage of the fat tails at the end? Well, clearly what you have to do is what Nassim Taleb does, which is allow yourself to have unlimited profits and assume or hope to capture these really strong, drastic moves. You don't have to go any further back than look at the Aussie pairs and the yen pairs at the end of 2018 to see what it looks like when the market really moves. And the thing is, if the market was really normally distributed and the movements were normally distributed, we would have moves like that about every 200 to 500 years. And the fact is, if you've been trading for more than 10 years, like I've been trading currency since 2001. So if you've been trading for a while, you have seen things like the flash crash in Japan, the recent Franco-Geddon that we had, the recent 2018 end of 2018 Aussie and yen crash. All of these moves, September 11th, all these really strong moves that have happened in the markets, they've all happened because people assume when they wake up in the morning, today's just going to be like yesterday. And the fact is, it's not going to be like yesterday. Because it might be, in a lot of cases it will be, but once in a while it's nothing like yesterday, and then we make up reasons why, oh, well, this is why it happened and this and that. That's the story of the Black Swan. If you haven't read that book, it's all about identifying what happened, and then we sort of talk it away. And this is why that happened, and make excuses why it happened. The reality is our cognitive biases are working against us, and one of them is the will to be right. You need to be right. And the hindsight bias that tells us, oh, well, we would have done this if that would have happened. Well, I'm not sure. Niederhoffer is a good example of someone who reportedly did not do that. So I hope this helps. I hope that you consider your cognitive biases, especially hindsight bias, when you're testing your systems and the need to be right. And I wish you happy trading. If you want to join us in Small Accounts, Big Profits, click the link below or above. We're going to take a small account and build it up. That's what that's all about. And we're using some aggressive risk management strategies. See you soon. Bye.